Okay, so what we want to do at this point is finalize linking current assets and current liabilities or the working capital into the cash flow statement. That will give us an almost complete cash flow statement that we can use to drive the balance sheet. So I kind of want to go through that process. Just one thing is, I think yesterday I pulled in the wrong deferred income taxes. I think I pulled in the long term. So if you have your model, if you have the one that I sent you yesterday and you're working off of that, then that's fine. But if you're working off of your own, F226 should be pulled in from F162. I had yesterday in class, I pulled it in from this long-term deferred income taxes. We're obviously dealing with working capital. It should be the short-term. Sorry about that. That's why that's highlighted. So what you want to do is you want to make sure that you are pulling in these line items into the working capital. So we have 1, 2, 3, 4 current assets. We have 1, 2, 3 current liabilities. And when you go to the cash flow statement, we want to just make sure that we have created our own working capital section that matches all the current liabilities we've identified below. So remember, the cash flow statement that we're doing here, as opposed to a standalone model, we're kind of creating this on our own, right? We have net income that we pulled from above. We have our adjustments that we made to depreciation. And basically, this whole other section, we just pulled in as all the line items from the acquirer and all the line items from the target, right? The changes in working capital we're creating based on the working capital that we've created and identified based on our balance sheet. So we have 1, 2, 3, 4 asset line items and 1, 2, 3 liability line items that have to match the line items that we've identified in the working capital schedule. And we want to pull them in and think about the way cash should be flowing based on balance sheet changes. So for example, when looking at accounts receivables or receivables, if the receivables are decreasing, that should result in what? Cash in or cash out? Decreasing asset, cash inflow, right? Think about buying selling an asset. You sell an asset, the asset goes away, you get cash for selling an asset. If you're buying an asset, the opposite thing happens. If you buy an asset, the asset goes up and cash goes out. So for every asset, this is true, right? For every asset, if the asset's going up, it's a cash outflow. If the asset's going down, it's a cash inflow. So we want to represent the proper cash movement in the cash flow statement. So it's going to be minus the change to represent that it's opposite of the way the balance sheet's moving. So if you look at the first line item here, changes in receivables, it's going to be equal to minus, in parentheses, 2013 minus 2012. Right? So the assets going up, this should result in a cash, the assets was going down, it should result in a cash inflow. Yeah, the assets going down, cash inflow. Next year, the assets going up, that should result in a cash outflow. So let's copy to the right and make sure that that's happening. Yes, so we're okay over there. And we want to do that for every asset. So I'm going to do it a little faster than the first time because I think you guys are pretty familiar with it. But the idea is we want to do minus the year-to-year change for every asset. So there's 3 more, right? So for inventories, it's going to be minus, in parentheses, this year minus last year. So inventories are going down. That should result in a cash inflow. Yeah. Prepaid expenses, another asset, same idea, minus the change. So prepaid expenses are going down. That should be cash coming in. And finally, same thing with deferred taxes. Deferred tax asset minus the change. Every asset minus the change. This asset's going up, so I should see a cash outflow. And I do. So I'll copy these to the right. So make sure you have that. Take a second if you need time to catch up. And as you are linking that up, the liabilities have an opposite effect, right? If the liability is going up, that's a cash inflow, right? Liability goes up, think about borrowing money. If you're borrowing money, the liability, you gain a liability, you get a liability, the liability increases, and you also get money. The liability up, cash comes in. If you're paying back that liability, you pay the liability off, you're spending money, cash goes out, and the liability goes away. So liability down, liability up, cash up. That's the idea. So what that means is if we look at the first liability here, which is accounts payable, accrued expenses, other accrued liabilities, that liability is going down. So we're paying that liability out. So that should result in a cash outflow. So this is the direct change. It's not minus the change. This is 2013 minus 2012. And for every liability, it works that way. So we have equals 2013 minus 2012. I should see a cash outflow there. And that's true for every liability. All right, for the income tax payable, it's going up. So I'm just going to do a direct subtraction. I should see cash come in. And other current liabilities, same idea. It's going down. I should see cash go out. So once you have all that, you should be able to add up the total changes in working capital. And that should give you, I think we've already netted that when we did the template. You want to make sure it's all adding properly. You should have 136.2, representing a sum of all the changes. It's working capital. And if you notice, in the working capital schedule, there's this match column on the bottom, right? What the match column does is it looks for the change that you have in operating working capital, the change that we didn't do yet, and it matches this number to the total change in operating working capital that we just calculated. 136.2 should tie with 136.2. And this is a good check. This is a test for you. It's just a proof to make sure that you have the signs going the right way, because that's a common mistake to make sure that your assets are negative the change and your liabilities are positive the change. And the way that works is you're really calculating changes in total operating working capital two different ways. Here, you're getting the differences of each individual line item and adding up the differences, whereas down here, you are calculating the total working capital and you're subtracting the total. So either you're getting the differences of each line item and adding the differences, or you're just getting the total change, assets minus liabilities, and subtracting the change. Two different ways of getting to the same number. And if that number doesn't match, then you must have the signs wrong. This is a good check. Everything is yes. So we're good with the working capital. So, I kind of breezed through depreciation and working capital, and we have a more abbreviated depreciation here, just to not be too repetitive, but I did have to kind of go through it because there are some similarities. If you're rusty with it, read the chapters and go through it again. Right? If you're really, really rusty, then go back to the blue book. But you have now 3 days to catch up on that. But that's all I'm going to say on this stuff. Now we want to apply this to the balance sheet. So you got the income statement, cash flow statement, depreciation schedule, working capital schedule. Cash flow statement's almost completely done. The only thing left are the line items related to debts that will come from the debt schedule. And my strong recommendation is to not do the debt schedule till the very end. There's no point in doing the debt schedule if you don't have a balancing balance sheet. If you are playing around with the debt schedule and your balance sheet doesn't balance, having the debt schedule linked in is just another degree of complexity that might cause an imbalance in the balance sheet. So get the balance sheet balancing first, keep it simple, and then layer in the debt schedule. That's my recommendation. So at this point, we can look to the balance sheet, which we've already kind of pulled in. We've adjusted the balance sheet based on the Office Depot Office Max merger. Now, how do we project this forward? So if you guys aren't familiar with the method that we did in the last group, it's written again, but more abbreviated in this book, so I recommend just to kind of go through it. But it's really important to understand the method of how to balance a balance sheet to avoid any balancing problems in the future. Or you can watch the video. I love the last class. I think I put it up on YouTube of how to balance it. But so the idea is each cash flow statement line item must drive the balance sheet line item in some way, an asset, a liability, or a shareholder's equity, right? So you really want to go in line by line and ask yourself two questions. One, which cash flow statement line item drives the balance sheet line item? And two, in what direction? Now, the directional thing is kind of easy because we know with all assets, it's the opposite. If cash is going out, the asset should be going up. If cash is going up, the asset should be going down. If it's a liability, it's what we just said. If cash is going up, liability going up. So the direction's easy. But it's more about making sure you're matching up each cash flow statement line item each time. So for you guys that have seen this with Walmart, I want to do it in a little bit different color. Same idea, but the way I'd recommend doing it, just because in a situation like this, we got a ton of these other line items. So I mentioned before, Walmart was kind of simple. There might be situations where you have all these other lines. How do you know where to put them in? So based on the standard theory of building the balance sheet, what I recommend first is just doing all the major line items, right? Obvious, right? So let's do the major line items. All these kind of more ambiguous line items like other assets, other liabilities, accumulated comprehensive income, save that for the end. So I want to pull in all the major line items that I know are obvious and check them off as I go. It's really important to check them off as I go because you know one of the major problems with balancing balance sheets is one, accidentally utilizing the same line item in two different places, or two, leaving line items out. And I think you've known from the first test how avoiding checking it off can avoid missing some obvious mistakes. So you really got to make sure you're checking off as you go along to prove that you're utilizing everything. So first thing, cash and cash equivalents comes from where? Changing to cash and cash equivalents, right? So obviously the way we do 2013 is it equals the year before plus on the cash flow statement changes in cash and cash equivalents because cash adds to cash. This is the one exception. I mentioned that in every asset, if the cash is going up, assets going down, the one exception to that is cash and cash equivalents. So we've generated 437.4 in cash. That's going to increase our cash balance. And I'm going to check that off. Receivables comes from where? Changes in the accounts receivable, right? Which has an opposite effect. So I'm going to have the 2013 receivables equals to the year before minus changes in accounts receivable from the working capital schedule. Meaning if it's plus 8.4, I'm going to see this go down. We've collected 8.4 on the receivables. This should go down. So let me just make sure I'm highlighting. I'm going to choose a different color here. No, not that kind of color. I'm going to highlight it, I guess this light blue, whatever. Okay. Next, inventories comes from inventories. So the working capital, the individual working capital line items comes from working capital. So this is going to be the year before minus the inventory. Pretty straightforward. And prepaid expenses is the year before minus the prepaid expenses, right? So I think you guys are familiar with that. And then deferred income taxes. So all the working capital comes from the working capital minus deferred taxes. So that's pretty easy. Let me highlight these working capital items that I utilized just to make sure that it's known that I've utilized them. And let me just total up the current assets. 5065.5. Everybody have this? Anyone need another second? Let me just save this. Okay. PP&E we know generally comes from depreciation and CapEx. It's an asset, right? So we got to stick with the opposite method. In other words, cash up, asset down, cash down, asset up. So we're going to use a minus sign. I mean, this is going to be equal to the year before minus CapEx minus depreciation. Minus CapEx minus depreciation. Goodwill. Let me make sure I'm highlighting CapEx and depreciation. Goodwill, you want to look to see if there's anything relating to goodwill. And there's not. There's no goodwill line item. Right? The goodwill from the transaction is already in there. It's already in the starting balance sheet. It's already in the 2034.1. So this will stay flat. And so sticking with the idea of, let me just link in the major line items. All these other ones, this is what I recommend. Let's get them out of the way. Everything else I'm going to keep as flat. Other intangibles, this one-off investment, the notes, deferred income taxes as an asset, I'm going to overlook. Usually if you have an asset, it comes through as a liability. So let me just keep that flat. And others kind of like a catch-all for all these other random line items, tiny ones that we don't know where else they can go. So we'll get to that. But let me just focus on the major ones, get the major ones out of the way, and we can step back and think about where these other line items can go. Okay? So everything stays flat for now. That's the way I recommend doing it. Makes simplifying what could be a larger problem. You see all these line items. Get the major ones out of the way. Okay. Current liabilities, easy. Comes from working capital. With liabilities, it's the opposite with the cash. Liability up, cash up. So if you see cash going up, the liability is going up. So it's going to be year before plus, not minus. So trade accounts payable is the year before plus. Trade accounts payable. Short-term debt, current maturities. The debts come from the financing activities. So this is going to be equal to the short-term debt and current maturities of long-term debt plus, we should have a line item for payments and borrowings of short-term debt. Even though that hasn't been linked in, we can still link it together. Income tax payable, working capital is the year before plus income tax payable. And other current liabilities is year before plus other current liabilities. Right? So let me just highlight the line items that I've utilized. Short-term debt and working capital. So working capital is done. And let me total everything up. You guys getting that? Any questions on that? Okay, deferred taxes. I want to analyze the deferred taxes a little bit later. I'm going to keep that flat. Long-term debt, we know comes from long-term debt, which is the year before plus the long-term debt, payments of long-term debt. Non-recourse debt is the year before plus payments of non-recourse debt. And so let me mark off the debts. And then we have some other of these non kind of one-off line items, right? Compensation, deferred gain, and non-controlling interest in joint venture. I'm just going to kind of leave those flat and go back and analyze those in a second. Yeah? You guys got that? Get the big items out of the way. That's my recommendation. I mean, okay, common stock. Anything stock related here? No. Actually, in the financing activities, we have proceeds from employee share-based transactions, non-controlling interests, and debt. Nothing related to the issuance of stock. So this will stay flat. Accumulated other comprehensive income. I usually think as separate from retained earnings, but there's no retained earnings, so they probably combine it. Some companies do. So this is going to be, for all intents and purposes, retained earnings. List the year before, plus net income after anything related to distributions. There's nothing. So just plus net income. Let me make sure I've utilized net income. Oh, treasury stock, there is nothing related to treasury stock, and preferred stock has been eliminated. I probably actually could have wiped out that line item. Okay. So we keep those flat. Redeemable preferred, I didn't see anything related to that. And non-controlling interest, let's leave those flat until we've identified them. And we'll just kind of total everything up, liabilities and shareholders' equity and the equity. So you should have 10483.1. Yeah? Okay. At this point, when you've linked up all the major line items, you basically have 5 or 6 categories of items to piece together. So I'm trying to make what is, for some of you guys, when you're asking me questions stuff, what can be look like a large problem, a simpler one, right? All these other line items could either go into line items of the same name. So, you know, we have a lot of things like compensation benefit obligations. Maybe one of those line items could be actually identifiable, and you would guess that based on the title of the name. Or we didn't talk about, but the intangible asset amortization going to intangible assets. So some of these line items we can identify. If you can't, they'd either be other current assets, other long-term assets, other current liabilities, other long-term liabilities, or accumulated other comprehensive income. There's only one of those 5 categories. And actually, I'll even simplify that further. Of those 5 categories, it wouldn't go into other current assets or other current liabilities, because if there was a line item that's related to other current assets or other current liabilities, it would have been in our working capital schedule. Our other current assets and other current liabilities are reserved only for working capital. You should never put anything else into other current assets or other current liabilities, assuming you're identifying those line items as working capital. So actually, there's really only 3 categories these line items can go into: other long-term assets, other long-term liabilities, and other comprehensive income. So that should simplify this. So the first thing you want to do is look at these line items and see if there are identifiable places they can go into. Things like I mentioned, intangible asset amortization into intangible assets. And if not, we have these 3 kind of catch-all line items that they can go into, and I'm going to help you identify which of those 3 buckets they should go into. Yeah. So first of all, let's start from the top here. So you can either go top down, or you can kind of scroll your eyes down and say, oh, I know this should go here, I know this should go there. So for example, amortization of identifiable intangible assets. This should go into intangible assets. So do we have a line item for intangible assets? Sometimes you do, sometimes you don't. In an M&A situation, you have to. We've created it ourselves. Yes, so this is going to go into the line item reserved for intangible assets, other intangibles. Whoa, what happened? So we had kept it flat at 190. We're now going to change this formula, G166, to be equal to equal to F166 minus intangible assets. Right? What else? Are there any other major line items we can identify? Here, this just jumps out at me. Assets. Usually items relating to assets, acquisitions, divesting, and we talked about divestitures, even gains and losses will go into PP&E. So let's see which should be going into PP&E. Disposing assets. Anything else? Anything else related to assets I'd put in there? Impairments. Loss of gain. Thank you. Sorry, I cut you off. We said it at the same time. I thought there was something else, but maybe not. So those 3 line items I'd put into PP&E. So I'm going to append the PP&E formula to tack on a couple more things, minus the proceeds from disposition of assets, minus the gain and loss, minus the impairment, and I'm going to highlight those to make sure I've used them in the cash flow. So I'm done with the investing activities. I've used the impairments and the gains losses. Okay. What else do we have here? I have, well, you can again go top down, or you can kind of I see something that's, non-controlling interests. We have a line for non-controlling interests. I just remember that, right? We have a line for non-controlling interests. We have two, right? We should have non-controlling interest in joint venture and the non-controlling interest. This one's from the acquirer. You got to think about what is it from. This is from the target. This is from the acquirer. And I did a little word search on that non-controlling interest in the cash flow statement. That a paragraph. It's in the book. I'm not going to go through the SEC files to look it up for you, but it was referring to the joint venture. They just spoke about it. It was clear. So it was easy to identify further where that would come from. So I'm going to add to this formula 184 minus that payment of the non-controlling interest, which is the payment of the non-controlling interest in the joint venture. Where did I see it? Here. So we've identified that. Okay. Now we have, let's say, deferred taxes. So we had two deferred tax line items. This one was related directly to deferred tax assets. So I put that in the deferred tax assets. So there was a couple things here. We had deferred income taxes on the asset side, and we had deferred income taxes on the liability side. So this is kind of a toss-up. And if you see things like that, I mean, if you had put both in the asset side, or one on the asset and one on the liability, it's going to net to be the same amount anyway of the asset minus the liability. So I don't get too concerned about these little things as long as it's in the balance sheet somewhere. Because if it's not, the worst thing to do is to exclude it from the balance sheet. If you exclude it from the balance sheet, then you are not going to have a balancing balance sheet. So what I had done was, I just want to confirm that that matched with the book. Yeah. So what I had done was, whoops. So the changes in deferred income taxes and receivables, that's obviously already been handled for in the current assets. The other two, the deferred income tax here and the deferred income tax expense, I just threw into the liability. That's what I had done. I think I kind of went back and forth on that. So I remember this. I identified the deferred income tax expense is definitely related to a liability. This one was actually a mixture of both. It had deferred tax liability and it had deferred tax assets in there. They lumped it together from different reasons. So where does it go if it's a mixture of both? You separate it, you put it in the it's not worth the time to separate it. So I just threw it all in the liability. Yeah. So what I had done was, when I went down to deferred tax liability, here I added to that as a plus the deferred tax expense plus deferred taxes and valuation allowances. Yeah? Question on that? No. No questions. Yeah, you guys all right? Any questions on this stuff? Yes.
I was talking with Kevin yesterday.
Yep.
Proceeds from acquisition, did that go into asset or liability?
Proceeds from acquisitions?
That's in the invested.
It's actually a mixture between assets and goodwill. But you'll never be able to separate that out. Right? That's like your purchase price. It's proceeds from proceeds from investing activities?
Proceeds from acquisition under the cash from
How are they getting proceeds if they're acquiring? Are they on, what side are they on? They must be divesting an asset and receiving proceeds. If it's money that they received based on a divestiture, doesn't make sense to me. That would go into an asset. If they're acquiring a business, I don't know why they received money from acquiring a business, but they spent money on acquiring a business, then it's going to also be a portion of goodwill or assets. Yeah. It must be proceeds from business acquisitions. Is that what you said? Okay. Yeah. Yeah, net proceeds from business acquisitions. That goes into a combination of assets and goodwill, and you'll never be able to separate that out. So I usually just throw it into PP&E. George, you're going to say something to that?
I was going to ask you, isn't it a line item that appears twice on, like, once you put it in CFO, because I think when you sell an asset, they're gain or loss.
As a divestiture, yes. That's why I asked her if it was one of the two. But if it's an acquisition side,
then it's only on the CFO.
yeah, then it's only on the cash flow from investing activities. There's no gain or loss.
Yeah, that's what it's.
Yep. So, and we saw that with Walmart. They had like a $3 billion acquisition. And in reality, some of that goes to assets, some of it goes to intangibles, some of it goes to goodwill. That's what we're learning this week. So you'll never be able to separate that out. So the question is, does it go into goodwill or does it go into PP&E? Should you put into goodwill and PP&E? And in all honesty, I don't think it's going to matter so much. It's all going to be part of total long-term assets. What did he say? Yeah. Kevin here or Kevin the associate? Oh, Kevin here. Oh, okay. Okay. I thought you were asking Kevin, I think the associate, but he's not with you guys anymore, right? Kevin's left, the real estate guy. He's gone. Okay. But that's that. Yes, go. And non-redeemable. So for whatever purpose, there's a portion of a non-controlling interest stake that a company can negotiate that they can call at whatever time. They can say, you know what, I'm going to buy back your stake. They have the right, based on whatever negotiations, to say at any point in time, they're going to redeem it, meaning they're going to pay you back and they're going to take that stake back. That's the redeemable portion. Does this company have that? No, but I think Walmart had it. That's what it is. It's a callable portion. How they get to that, it all depends on negotiations. Any other questions? Okay. Another thing. So another line item I've identified here that could have some things that go into it is compensation and benefit obligations. Anything related to compensation to benefits. So if you see here, there's a couple line items related to compensation. You could just I'm talking about just looking at the titles of the line items to best guesstimate where things are going. Compensation expense, right there, it goes right in there, right? Compensation. There was another one that was talking about benefit obligations. Pension and post-retirement benefits would go in there, right? So those two line items we'd link in there. So anything related to compensations, benefits, that's pension and compensation, 71 and 76, I'd link in there. So I guess taking best guesses. Plus 71 plus 76. So slowly narrowing down, what's left outstanding. You have that? Question on that? So what else do we have left that we can maybe allocate into known places? We have losses on inventories and receivables. We have earnings from equity method investments. Other operating activities is going to go into other. Non-cash impairment charges. Other is going to go into other, of course. Employee share-based transactions, debt-related fees, etc. Okay. Any ideas as to where those can go? So, charges for losses on inventories and receivables. If you're losing inventory, that's definitely going to affect the assets. You can kind of guess where that's going to go, right? So there's really no line item for losses on inventories and receivables. There's inventories and receivables, but that's already pulling in from working capital. You don't want to touch working capital. Working capital is done based on the working capital schedule. So this is one of those items that has to just be lumped into other assets, other long-term assets. It can never go into other short-term assets because other short-term assets comes from working capital. You don't want to touch working capital. So 68, I'm going to pull into other non-current assets. There's really nowhere else you can go if we think about it that way. Does that make sense? Yes? No? 68? Earnings from equity method investments, I'm going to put that into other comprehensive income. If it's equity related, if it's related to equity, it's going to go into other comprehensive income. Other operating activities, this is another other category. If it's related to operations, it would either be an asset or a liability. I don't know if this is related to an asset or liability. I'm going to guess this is an asset. I'm going to lump this into other assets. Usually by default, I choose assets over liabilities. If you've noticed, we've already lumped pension obligations into other long-term liabilities. This company actually does not have other long-term liabilities. They have compensation, benefits, and other long-term liabilities. So I reserved that for compensation and benefits. So I'm going to lump this into other. Any questions on that? And then this other, again, a mystery, other, this could be an other asset or an other liability. I'm going to put it into other assets because I use that by default for the same reason. So if you see other stuff, if it's related to equity, I'd put that into other comprehensive income. If it's related to like operations or investments, it's going to be an asset or a liability. And I usually default to assets unless it's clearly defined as a liability, like an obligation, investment in pension funds, things that are clearly related to liabilities. That's how you narrow down these mysterious line items into those three buckets. Yeah, so the three line items we defined as other, I'm going to link into other assets, other non-current assets, which is right now we kept it flat, which is going to be minus other at the bottom, 78, minus 74, other operating activities, minus charges for losses on inventories and receivables. That's clearly related to assets. We are now left with what? Impairments, equity method investments, share-based transaction stuff. This is all related to equity. Debt-related fees, fees related to debt, that's other comprehensive income. Effective exchange rate on cash equivalents, other comprehensive income. These 5 line items are other comprehensive income. Any question on that? So, other comprehensive income, I'm going to link into that. Anything related to equity, where are we? Right now, we're already adding net income. I'm going to link to that from the bottom. Cash and cash equivalents always goes in there. Anything related to one-off fees, expenses on debt and equity go in there. That's this debt-related fees. Proceeds from employee-based share transactions. Anything else related to equity, that's the equity method investments. Yeah. So all those line items are related to other comprehensive income. So that's making sure we highlight everything. Whoops. And I see we left out, I didn't pick this up before. This is an impairment. Impairments we had related to, I'm assuming this is a property impairment, an asset impairment I related to PP&E. So let's add this to PP&E 75. So I forgot, it looks like I left something out. PP&E, I'm going to add to that minus this non-cash impairment. And we should balance, no. Did I forget something? I just included that. Did I mix my pluses and minuses? Let me see if I mixed something. My totals are okay. Let's check real quick. Oh, here we go. I should have done a plus there. There we go. Good. If that balances, copy to the right, and we have a balancing balance sheet. So to summarize what I'd done, because it might have seemed a little complicated and haphazard, but there's some logic to it. You first highlighted the major line items, and all the major line, got those out of the way. To me, it's easier just to see what's left over. Of what's left over, you kind of have to look at the line items, and even just judging from the name, which line items should go into line items that we can identify, such as intangible assets, amortization going into intangible assets. Obvious, that's not an everyday line item, but that's one that you can look at and say, all right, well, that's going to go into intangible assets. Tangible asset line items going into PP&E. Impairments, asset impairments, gains or losses on sales, acquisitions. So we identified those line items. There were 5 of those that went to PP&E, so we slowly narrowed it down. We then looked at and we identified benefit and pension plans. And in honesty, at first glance, I didn't notice that. But then as I was narrowing down, I said, wait a minute, there's a liability line item that's specifically stated reserved for pension plans and contractual obligations. So I linked those 2 line items in there. Then we were left with 8 line items that can go into really 5 different categories, right? Other line items left over can go into other current assets, other long-term assets, other current liabilities, other long-term liabilities, or other comprehensive income. Of those 5 line items, you can eliminate other current liabilities and other current assets because those are reserved for working capital. You don't want to mess with working capital. We already have that linking in the working capital schedule. So you really have items that would go into other current assets, other current liabilities, or other comprehensive income. So you can identify which ones clearly go into other comprehensive income is the line items related to equity or debts, related to the financing activities. Right? So those line items were debt-related fees, equity-based compensation. There was always, which goes in there, is the bottom of the cash flow statement, the currency-based change. And then one line item in the operating activity, which was the equity method investments. Equity. That was my guess. And then we were left with 4 different line items that clearly were stated, 3 of the 4 were stated as other. So you said they go to other assets and other liabilities. I usually throw everything into other assets unless it's clearly identified as a liability, such as pension obligations. But again, since assets net from liabilities net from the assets, if you were to move some into liabilities, it's not going to affect your model so much. But it was other operating activities, and it was net charges for losses on inventories and receivables, this is definitely asset based. These other two were kind of tossed up and I threw into other assets. That covered everything. So just hopefully ways you can step back and think about, which might look like a really complex task, into just a series of buckets, right? And then so now you might think, well, I don't know where this goes. Now you should think about, well, I don't know if it should go into one of two line items. You're narrowing down the complexity. And then you can say, all right, well, if it's a toss-up between one or two, I'll just throw it into one place. And at least you're building a better model. That's the point. Any questions on that? So, this part's a little repetitive, so I tried to make it new and interesting. I don't know. Interesting. It's never interesting, right? Thanks. But so if you're rusty on some of the stuff, read those chapters, 9, 10, and 11. If you're not, then you don't feel like you have to worry about it. But the balance stuff is in there as well. On Monday, I want to recap the whole process to now. I want to give you guys a simplified way to get to the merger model up to this point. And then I want to put together a debt schedule. I want to analyze it. I want to look at this contribution analysis, some other analyses. By Tuesday, Wednesday, we're going to start to get into LBOs.
Monday or yes?
No, the next Monday. No exam Monday. Great.